The Federal Reserve Bank, Fed, has completely changed its position. I'm not talking about temporary inflation here. Back in 2023, the Fed stated that a mild recession was, quote, the base case for our economy. Since then, the Fed has not only canceled its recession forecast, but they have gone so far as to say that there won't be a recession in 2024. The Fed now anticipates significantly faster economic growth in 2024, 2025, and 2026 than they did previously. The stock market, gold prices, and even the price of Bitcoin have all experienced significant growth. So let's get started. First, let's analyze the state of the economy, including the housing and stock markets. Next, let's discuss Bitcoin and gold, as well as what this implies for your wallet and where the best possibilities are right now. In order to comprehend the true nature of our economy, one must grasp the mechanisms that drive it. For example, let's say I enter McDonald's, open my wallet, pull out a crisp $100 bill, and proceed to the cashier telling her, "You know what, let me get a Big Mac, actually cancel that, I don't want anything." I walk out. Now, it won't be a huge concern if I'm the only one who does that, but let's imagine that everyone who enters McDonald's does the same thing. They take out some cash, but they say, "You know what, I'm not going to give you any money," and they leave. Now that this McDonald's store is not going to turn a profit, it might not be a big deal for a little while, because the McDonald's franchise probably has some cash savings, so they can continue funding their expenses out of their own pockets, paying rent and paying salaries. However, if customers continue to come in and not spend any money, eventually the store will go out of business because the owners will say, "You know what, this store is not working. We have to fire the employees. We need to demolish this building in order to be able to quit paying our mortgage, rent, and other obligations." As a result, our economic system is based on consumer spending, which means that when our economy is booming, people are spending money. In 2023, consumers spent a record amount of money, and they are expected to continue spending money like crazy in 2024. This is great news for the economy because it keeps the machine running. However, if people were coming in and buying a lot of food, the store could continue to operate. Perhaps they would even open up another McDonald's right down the street because of how much money is coming into this business. However, the question that needs to be addressed is how well people are actually using this money in 2023. A record number of Americans took money out of their 401(k)s in 2023 in order to continue spending. In fact, nearly 3.6% of employees in employer-sponsored 401(k) made a hardship withdrawal in 2023, the highest percentage since Vanguard started collecting data on this topic in 2004. This indicates that more people were using their 401(k)s in 2023 to pay for their expenses than in 2008 during the Great Recession. Not to mention that credit card debt reached a new high in 2023. It appears that credit card debt has returned to a pre-pandemic level. And let's not forget about buy now, pay later, or what I like to call broken now, broke later. When it comes to buy now, pay later, clothing and accessories were the most popular product category among millennials and Gen Z users. This indicates that our economy has been growing because people are spending money, but they aren't just getting it from their income. They are also getting it from credit cards, 401(k), accounts, and other forms of financing. As a result, people may not be living within their means, which is okay in the short term but could cause problems in the long run if they eventually run out of money. In addition to losing their money, those who lose their jobs also lose their credit, making it extremely dangerous for them to continue as consumers. Spending money you don't have on things that don't really make you money is driving up prices, so even though the economy is booming, there are risks associated with it. This brings us to our second point, which is the current state of the housing market. Although I took an economics class in college, I never understood how supply and demand worked. Basically, when there are more buyers than sellers and more demand than supply, home prices rise because there are many people bidding for a single property. Conversely, when there are more sellers than buyers, prices decline. Because home sellers are now in competition with one another for the one buyer, this drives down property prices. When there are few buyers, how do home sellers compete with one another? They lower their prices, which is what we're seeing today as we record this video. More people are listing their homes for sale, which indicates that supply is starting to rise a little bit. However, this increase in inventory of homes for sale is far from sufficient because there are still many people who don't want to sell their homes because they argue that since they currently have a 3% mortgage, why would they want to sell now and then go get a 7% mortgage somewhere else? I'll just stay in my house because home values have increased so much that there aren't really any foreclosures going on. If someone is having financial difficulties or has lost their job, there's a good possibility they can still sell their house for a profit and take home some cash. The reason why there aren't as many foreclosures is that you can't afford to pay your mortgage. We have seen a slight increase in supply, but overall it is still relatively low. On the other hand, demand is still high because the sticker shock of people realizing they could never afford a 7% mortgage has subsided. Although demand isn't as high as it was during the 3% mortgage era, it is still high. Therefore, we could say that demand has decreased slightly in comparison to a few years ago. However, demand is still high, so what does it mean? 2 or 3 years ago, supply was much lower and demand was much higher. Today, supply and demand are more evenly distributed, but there is still more demand than supply, which is why there are still bidding wars and many buyers struggling to find a home in many neighborhoods across the nation. However, not all neighborhoods are seeing an increase in home prices because real estate is very localized in the Midwestern United States. While Detroit and Michigan are currently experiencing one of the hottest housing markets, other cities that saw a boom during the pandemic are actually seeing a decline in home prices. For instance, the median sales price of a home in Austin, Texas, dropped by 16% between May 2022 and May 2023. In general, throughout the nation, supply has increased and demand has decreased. But there are some areas that are experiencing more aggressive supply growth than supply, such as the Midwest, not to mention Detroit, where prices are still rising. These areas include Austin, Texas, and a few other cities that saw rapid growth during the pandemic. Real estate is localized since there is still more demand than supply. But keep in mind that supply and demand determine pricing, which gets us to number 3. The S&P 500 is up roughly 10% year to date and up roughly 80% over the last 5 years in the stock market. Keep in mind that the S&P 500 is an index, which is a collection of the 500 largest companies on the stock market. What's more intriguing about this significant increase in the stock market, in particular the S&P 500, is how heavily weighted just 9 stocks are. The S&P 500 rise can actually be attributed to just 9 stocks, which include Apple, Microsoft, Nvidia, and a few more stocks. Now, if you've watched any of my videos on stock market investing, you may have heard me discuss how I've been utilizing several ETFs to invest my money passively in the S&P 500. Some people are worried that this could potentially be creating a bubble at this point, but I'm investing for the long term, so I know that market crashes do occur, and they will keep happening because they provide me the chance to enter the market and invest even more aggressively because my goal isn't only to hold onto my stocks for 2 years. I was having a discussion with some of my content team members at Briefs Media just before I recorded this video. These are some of the team members that write market briefs, and we always try to have these discussions as a way to provoke thoughts and help create creativity while we write. I was asking them some questions because I know that investing has risks and that you're never guaranteed to make money when you invest. In fact, you will probably lose money. When the markets flourish, as we have been witnessing, is it good or bad? We discussed this. What about when the markets crash? Is it good or bad? One of the things we discussed was that, in essence, it depends on who you ask. It's advantageous for those who already own the asset, but it's not so advantageous for those who don't, as it will now cost you more money to purchase stocks if you want to acquire them because they are more expensive. In the same way, Whether a market crash is good or bad depends on who you ask. If you own stocks and they are crashing, it's not so good. If home prices are booming, it's great if you own a home, but not so good if you want to own one because it will cost you more money to own and your rent may be higher. However, it's wonderful if you have cash. However, despite the fact that most buyers of both commodities don't get along, they share a similar mindset in that they're concerned about the dollar losing value due to inflation. As a result, they're turning to this hedge, with some turning to Bitcoin and others to gold. In other words, they're buying these assets almost for the same reasons, despite some differences. However, they don't get along very well. Physical gold is special because it has been used as a hedge for as long as people have used money, making it tried and true. People value gold in Canada, Mexico, India, and the United States, and gold is recognized by people all over the world. Now that Bitcoin ETFs have actually hit the market, the cryptocurrency is beginning to acquire popularity and has been increasing significantly. In fact, Michael Saylor and BlackRock have been vying to see who can possess the most Bitcoin. For those unaware, Michael Saylor is one of the most vocal and well-known supporters of Bitcoin. While there are obviously uses for Bitcoin that gold does not have, I won't go into those in this video. Instead, I want you to understand that people purchase both Bitcoin and gold for comparable purposes. Currently, Bitcoin is considerably more speculative than actual gold. A portion of my portfolio that is speculative includes Bitcoin. Gold is a part of my hedging portfolio. When I purchase it, I do not view it as an investment. Rather, I view it as a substitute means of preserving hard cash. Similarly, when I purchase Bitcoin, I am engaging in speculative activity. I purchase it with the purpose of using it as a speculative investment because I recognize the risk involved and am fine with it. It is not a significant portion of my portfolio because I am aware that it is speculative. I use gold as a means of saving real money. I look at it differently, but from both of these angles, there has been a rush of money coming in, and a major factor in both of those events is that people are still concerned about inflation because even now, inflation rates are higher than anticipated, which has increased the value of both of these assets. When we combine all of this, we see that the economy is growing because people are spending money, but there are also warning signs because some people are running out of money. Additionally, the growth of institutional money into things like Bitcoin is one of the reasons why the price of Bitcoin has been rising as well. Lastly, the housing market is supported by the economic system because people need an income to go out and purchase a home, and they also need an income to make their mortgage payments. The reason the stock market is fueled by this economic system is that the top companies are the ones that trade on it. If these companies are profitable, people will want to invest in the stock, and they will also need money to purchase stocks, giving them the funds to do so and the funds to spend at the companies that can support the stock market. And this is also what drives the surge in both Bitcoin and gold prices, because individuals need money to purchase Bitcoin and, ultimately, gold. As a result, the robust economy we currently have is driving this trend. Nevertheless, you should keep an eye on this, as well as what the Federal Reserve Bank is doing and the fluctuations in interest rates. Keep an eye on the developments around unemployment rates, as well as economic expansion, since nothing can rise straight up indefinitely. Although the exact timing of the economy's slowdown is unknown, we do know that it will occur eventually. Recessions have occurred in the U.S. almost every decade over the past century. This is just a fact. So if we know this will happen, we can be sure that there will be an economic slowdown eventually. We don't know when that will happen, but we do know that it will affect housing, stocks, Bitcoin, and gold. What does this mean for you personally? It doesn't mean you shouldn't invest. Rather, it just means you need to be aware of what's happening so that when things get tough, you have the money to come in and get even more aggressive. According to Warren Buffett, investing over time is preferable to timing the market because no one can foresee what will happen to the markets on a given day. If you wait around for the markets to crash, you might have to wait for years and miss out on years of profit. However, if you invest consistently and a market crash occurs, you will have the opportunity to enter the market and make even more aggressive investments. This is where having a solid financial education comes in handy when investing because, in addition to understanding the psychology of investing, you also need to know what you're investing in because, secondly, people will invest in bad assets, which will cause the markets to decline. When the economy declines, their investment may lose value, possibly as a result of taking on excessive debt or making an unwise purchase, which is currently bankrupt, and you could lose everything as a result. This is why it's critical to have a solid financial education, as well as to understand the types of investments you make and how to make them so that you can combine the two. These are topics I'll be covering on our channel, of course. Jamie Dimon recently stated that Wall Street is overly optimistic that our economy would enjoy a gentle landing and escape a recession. For those unaware, Jamie Dimon is the CEO of the biggest bank in the country. He just stated in an interview with CNBC that he believes investors have unrealistic expectations for the U.S. economy. In conclusion, the resilience of the economy has once again proven that it cannot be stopped. Despite facing numerous challenges from global pandemics to financial crisis, innovation, adaptability, and the determination of individuals and businesses have propelled us forward. As we move ahead, let's stay informed, make wise investment decisions, and continue to navigate the ever-evolving landscape of the economy. Remember to like, share, and subscribe to Investing Tutorial for more insightful discussions on navigating the world of finance and investments. Together, let's seize the opportunities and thrive in this dynamic economic environment. Thank you for tuning in, and until next time, happy investing.